It is 1998. You are not reckless. You are just paying attention. The internet is changing everything, and everyone you respect is saying the same thing. Get in now or get left behind. So you get in. For a while, it feels like genius. Your portfolio is up. Your friends are up. Strangers at dinner parties are talking about their returns. Everyone is winning. Then one morning in March 2000, you wake up and the number on your screen is wrong. Not slightly wrong, catastrophically wrong. The NASDAQ loses 80%. Companies worth billions become worth nothing, not less, nothing. Friends who were millionaires on a Tuesday are making payment plans on a Thursday. And the brutal part, the internet was real. It was always real. You were right about the technology, you were just wrong about the price. Now it is 2025, and I need you to hear something. That feeling is back. This time, it is not the internet. It is AI. And the numbers involved make the dot-com era look like a trial run. Before you do anything with your money, you need to understand three things. The arms race nobody can afford to lose. The money machine that might be built on circular logic. And the wall that nobody is talking about publicly, but everyone in the industry is quietly worried about. Let us start right now. 7 companies are deciding the future of your portfolio, whether you know it or not. Amazon, Microsoft, Alphabet, Meta, Tesla, NVIDIA. They are called the Magnificent Seven, and together they make up roughly 36% of the entire S&P 500. If you own an index fund, more than a third of every dollar you have invested is riding on these 7 companies winning an AI race that has no finish line, and they are spending like it. Tesla, $5 billion. Apple, $10.7 billion. Meta, $60 billion. Google, $75 billion. Microsoft, $80 billion. Amazon, $100 billion. Total, in 1 year, $330 billion. That is larger than the entire economy of Portugal, spent in a single year on a technology that has not yet turned a meaningful profit. Here is what makes this stranger. This spending may be the only thing keeping the broader economy healthy right now. Remove it, and several economists believe the United States slides into recession. The AI arms race has quietly become load-bearing infrastructure for the market you are already invested in, which raises a question nobody wants to answer out loud. What happens when the spending slows down? Now, let us go underneath the spending, because this is where it gets uncomfortable. It has been called the AI money machine, and once you see how it works, you cannot unsee it. NVIDIA sells the chips that power AI. OpenAI buys those chips to build its models. Oracle builds the data centers and leases computing power back to OpenAI. On the surface, a normal supply chain, but watch the money. Microsoft invests $58 billion into OpenAI. OpenAI pays that back to Microsoft for cloud services. Microsoft uses that revenue to buy NVIDIA chips. NVIDIA invests back into OpenAI. Every transaction gets recorded as revenue. Every revenue number pushes a stock price higher. Every higher stock price attracts more investment. Here's the simplest way to understand it. You pay a friend $1,000 to dig a hole. He pays you $1,000 to fill it back in. You both report $1,000 in revenue. You are both technically profitable businesses. And if someone values you the way the market values OpenAI, at more than 40 times revenue, your hole digging operation is suddenly worth over $40,000. The real situation is more complex, but the principle is the same, and it has been escalating. OpenAI announces a $300 billion deal with Oracle. Oracle commits to spending tens of billions on NVIDIA chips. NVIDIA pledges to invest $100 billion back into OpenAI, but only if OpenAI buys more chips first. Follow that chain. OpenAI pays Oracle. Oracle pays NVIDIA. NVIDIA pays OpenAI. Everyone books revenue. Everyone's valuation climbs. NVIDIA, sitting at the center of every single transaction, has seen its stock rise 1,600% since ChatGPT launched. Now here is the number that should stop you cold. OpenAI is valued at $500 billion. Its annual revenue is roughly $12 billion. It is losing money every single month, $500 billion. Losing money every month. In any other era, that is a warning sign. Right now, it is called visionary. The third force is the one least discussed, and it may matter the most. It is called the data wall. For the past several years, AI has improved at a rate that genuinely surprised even the people building it. But most of that progress came from one place: feeding these systems more data. Books, research papers, websites, decades of human knowledge, compressed and processed at scale. By 2027, researchers expect AI systems to have consumed essentially all publicly available human-generated text on the internet. Every article, every forum post, every digitized book, everything humanity has written down over centuries. Processed. And then what? The valuations being assigned to AI companies today assume that progress continues at roughly its current pace, that the systems keep getting smarter, more capable, more economically valuable. But if the improvement has been driven primarily by more data, and the data runs out, the assumption underneath those valuations starts to crack. There are possible solutions: synthetic data, systems that learn from interacting with the world rather than reading about it, new approaches that nobody has fully proven yet. Maybe one of them works. But here's the critical distinction. The $300 billion being spent this year is not contingent on those solutions working. It is being spent on the belief that they will. That is not the same thing. So let us look at the full picture honestly. An arms race consuming hundreds of billions annually with no clear endpoint. A financial ecosystem where the largest players are so intertwined it is genuinely difficult to separate real demand from circular momentum. And a technological constraint that could slow progress at precisely the moment markets expect it to accelerate. Is this a bubble? Probably. The signs are familiar enough: extreme valuations, mutual reinforcement between major players, a gap between the story being told and the profits being earned. But here is where the dot-com comparison breaks down, and this matters. The companies at the center of the AI wave are not hollow. NVIDIA is genuinely profitable. Microsoft is integrating AI into products people actually pay for. Google's core business is genuinely at risk if it does not adapt, which makes the investment strategic rather than purely speculative. These are real companies spending real money on a real technology. The problem is not that AI is fake. The problem is that the valuation of AI has outrun the proof. The profits that would justify $500 billion price tags are still theoretical. The productivity gains that would reshape the global economy are still partial and uneven. History has a word for the gap between a genuine technology and the irrational investment narrative built on top of it. It calls it a bubble, and it does not particularly care whether the underlying technology was real. The internet was real in 1999. That did not stop the NASDAQ from falling 80%. So, what do you actually do? Keep investing steadily into diversified, low-cost index funds. Not because markets always go up in the short term, they do not, but because exiting requires you to be right twice: when to leave and when to come back. Most people are wrong at least once. Understand what you actually own. When 36% of the S&P 500 is concentrated in 7 companies, all betting on the same technology, that is not diversification. That is a sector bet wearing an index fund costume. And keep growing your income. The investor who keeps buying during a crash comes out ahead. That requires having something left to invest when prices fall, but beyond the tactical, there is something bigger worth sitting with. We are living through a genuine technological shift. AI will change significant parts of the economy. Some of those changes will be profound. The technology is real and the stakes are real. The question is not whether to participate. The question is whether the price being asked today accurately reflects the future being promised. The last time we saw language this confident, numbers this large, and narratives this urgent, it did not end quietly. The internet survived the dot-com crash. Amazon and Google eventually became the most valuable companies in human history. But the people who bought at the peak in 2000 waited over a decade just to break even. Real technology, real winners, real losses. History does not repeat. But right now, it is rhyming very loudly. And the only question that matters is whether you can hear it. The question is not whether to participate. The question is whether the price being asked today accurately reflects the future being promised. And honest people can disagree about that. What is harder to disagree about is this: the last time we saw language this confident, numbers this large, and narratives this urgent, it did not end quietly. The internet survived the dot-com crash. The companies that survived it, Amazon, Google, eventually became the most valuable businesses in human history. But the people who bought at the peak of the bubble in 2000 waited over a decade to break even. Real technology, real winners, real losses. History does not repeat, but it has a way of making the same argument twice. And right now, It is clearing its throat. If you want to see more of such informative videos, please subscribe this channel and press the bell icon so that you do not miss any new videos. Also comment down below, which topic would you want me to cover next? Every feedback is welcome. So keep watching and bye for now.